I think Canadian real estate is a bad investment at the moment, and I'm going to give you some reasons why. Right off the bat, I think the biggest, baddest reason why real estate is a bad investment at the moment in Canada is because the more you pay for something, the lower your subsequent returns are going to be. And I want to repeat that point because hundreds of years of economic history suggest people don't actually get it. So again, the more you pay for something, the lower your subsequent returns are going to be. It's an economic fact. And I'll use an example from my own life to drive the point home. It was in March of 2000, I bought some real estate in Toronto, and I sold it in November of 2012. And over that time, I made a 10.5% return on a price-to-price basis. I'm going to ignore property taxes and the renovation costs I had to put into it, because whenever we talk about real estate, those costs magically go away. And so I'm just going to talk about price to price. So I bought at price X, I sold at price Y, and over that time, I made 10.5% return. Great. For the people who bought from me, in order for them to have the same return, the 10.5% return over the same period of time, the property is going to have to be worth about $2.5 million in 14 years. And if you knew the property, you'd know that's just impossible. It's not going to happen. And so the return expectations for people buying now have to be, dropped a little bit. And when I post this video, I don't want to hear people saying, well, I bought real estate in 2000 and it did really well. Not relevant to someone who doesn't have a time machine today. The people who buy today are going to have lower returns going forward than the people who've bought over the last 20 years. For the next reason, I'm going to use a quip from Yogi Berra. That neighborhood's so expensive, no one can afford to live there. And that's really what's going on in Canada. According to the OECD, the income gap, or the gap between income and house prices in Canada is unsustainably high. And the OECD is calling for a 30% correction in Canadian real estate. I think that's a bit conservative, but that's what they say. And here's the point of it. Over time, looking at Toronto as an example of Canadian real estate, over time, house prices range between 3.5 and 4 times median income in an economy. And median income in Toronto right now is about $70,000, which suggests that house prices are massively inflated in the Toronto real estate market. That's another reason why people who buy today are going to have poor returns on their investment over time. It also reminds me of a conversation I had with Stephen Jaroslawski about 6 years ago when I interviewed him for the documentary that you can also see on this page. He made the point when talking about American real estate and how people fail to analyze that correctly. He said that over time, real estate can't really grow in price by more than productivity and inflation, because if it did more, over time, eventually only some billionaires could afford to live in a house, which is impossible. So at some point, the real economy, what's happening in the real economy matters to real estate prices. And right now what we see is there's a huge disconnect between real estate prices, especially in Toronto, and what's happening in the real economy, with employment and inflation and so on. Speaking of the real economy, let's look at debt. Unlike their American counterparts who are deleveraging or lowering their debt loads, Canadians are piling on debt like never before. On a ratio of income to debt, Canadians are sitting on somewhere between 160 and 165% of debt, which means that for every dollar of income they bring in, they've got $1.60 to $1.65 of debt outstanding. Now, why is that relevant to real estate? Well, if Canadians are maxed out in the parlance of our time, they are less likely or less able to get a mortgage, and mortgages are really important to real estate. And so our capacity to service mortgages and our capacity to get mortgages really drives the price of houses and real estate. And if we can't do that because we're maxed out, that's going to do one thing and one thing only: to price of real estate. It's going to make it go down. Here's another interesting argument for why real estate in Canada is overpriced. It's actually getting cheaper to rent in Canada. The Economist magazine puts out this metric every year where they compare the price of owning a certain property to the price of renting that same property or a very similar property. And the costs of ownership so-called ownership in Canada are way out of whack with rent. So if I had a 3-bedroom condo in Toronto, it would cost me X amount per square foot to own it, or to basically have the Royal Bank or one of the Canadian banks as my landlord. And if I rented that same spot, it would be a lot cheaper if I had, Lou down the street as my landlord. And so on a dollar savings basis, renting actually makes some sense in Canada at the moment. Now, the argument I've heard against rent is that, why would you want to just throw your money down the drain by renting? It makes no sense to just pay off someone else's mortgage. Let me deal with that argument in a couple of ways. First, if you look at the amortization table of a 25-year mortgage, the first, I think it's 14 years, is mostly interest. So you are, in a sense, just pouring money down a rat hole when you have a mortgage. You're not actually building any equity. The idea that you're building equity by paying down your mortgage assumes that the price of the thing that you're paying down does not drop in price. Okay, so as an example, let's say you have a $100,000 house, you've got $20,000 of equity in it, there's an $80,000 mortgage, that house drops in price to $60,000, your equity gets wiped out, and any amount that you've paid off on the mortgage gets wiped out. It just becomes pure debt at that point. So the idea that renting destroys value and owning a house at whatever price creates value is a really, really naive and actually kind of dangerous urban legend. The next reason why I think real estate is overpriced, well, it gives me an opportunity to sort of poke fun at economists, which is something I love to do. There's economists in Canada, CIBC, I'm looking in your direction, that suggest that owning a house in Canada or maintaining a mortgage in Canada is actually not too bad. It's actually pretty affordable. And this gets to one of my big criticisms of economics as a science. They use a device called ceteris paribus, which means roughly holding everything else constant or keeping everything the same. And what the argument from certain economists who also happen to work for institutions with huge mortgage books that make huge amounts of money by lending people mortgage money, but we'll leave that aside, that cynical argument aside for another day. Their idea is, well, if everything remains constant, people can actually afford the mortgages that they have now in Canada. The problem is, and there's lots of history to suggest this, interest rates change over time, employment changes over time. You can't really hold everything else but one variable constant. It's a silly idea and a dangerous idea to suggest that people can afford mortgages in Canada over time. Real estate is a long-dated asset, which means that you're going to hold it for multi-decades. And in multi-decade periods, you're going to go through different interest rate regimes. And so just because it's affordable when interest rates are at historically low levels doesn't mean it's going to be affordable when interest rates rise. Not if they rise, but when they rise. Take that lesson, CIBC. Now, why is this relevant to all Canadians, even Canadians who aren't speculating in the real estate market? There are certain types of bubbles in hockey cards, for example, or beanie babies, or bitcoins, that actually only affect the people who speculate in the asset class in question. And it doesn't really affect the rest of us that much, so they're not that pernicious, they're not that destructive. But in the case of real estate, it actually will affect the real economy because it affects what's called the wealth effect. And more importantly, I think, and more directly, construction jobs represent a huge percentage of the Canadian economy on a percentage basis. And so when those jobs go away, that's going to have spillover effects to the rest of the economy, and it's going to hurt people who are innocent parties, in my view, people who didn't have anything to do with participating in the growth of or the speculative bubble in Canadian real estate. And that's why I think every Canadian should care about what's going on with real estate, whether they own it or don't. When it goes out to sea, or when it drops in price, or when it simply flatlines, a lot of jobs are going to go away in the construction sector, and I think policymakers should be aware of that, and I think we should gird ourselves accordingly. On a risk-reward basis, somebody is better off doing something else with their money. You can't buy a piece of real estate that by every metric in the world is overvalued today in the hopes that in the next 10, 15, 20 years, Toronto is going to magically transform itself into the next New York City. and your houses in downtown Toronto are going to be the next brownstones, for example. The capital involved means that on a risk-reward basis, it's just too scary a bet to take, and so I would not take it. That's why I have sold off all of my Toronto real estate. Anyway, thank you very much again for watching. That about does her, wraps her all up, and I look forward to seeing you again.